Good afternoon. Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at MarketSite is Gannon. He's a co-chief investment officer over at Royce Funds, and we're going to focus on inflation, rising interest rates, and the impact to small cap stocks. Thank you very much for joining us.
Thanks for having me.
Over at MarketSite. Now, how do rising interest rates and inflation impact the small cap stocks?
Historically, it's been a good thing. If you go back and look over time, and the rising interest rates is actually beneficial to small cap companies. And I think one of the things we've been seeing in the market over the past several years is a more normal environment. And in a more normal environment, you're going to have higher rates. And I think that's a good thing. It's actually a healthy thing. It's representative of a healthy environment, a healthy economy, which is very good for small cap companies.
Now, when we take a look at the Russell 2000, because that's what incorporates most of the small cap stocks here, is it looking increasingly risky, and why?
I think people miss the index itself. The index itself, I think, is fraught with a lot of risk on a couple of levels, and rising rates actually fits into that discussion, because if you look at the Russell 2000 today, a little over a third of it, close to 34% of the index actually has no earnings. So there's a lot of embedded risk there. And then also it's becoming increasingly leveraged. You know, we're a firm that historically has loved operating leverage, but not financial leverage. The index itself is becoming increasingly leveraged. I'd say there are companies in the Russell 2000 that are serial leveragers, financial leveragers, and they didn't use the low rates to take advantage of that. They didn't take advantage of that. And so it's something that we think is adding to the risk of the overall market that investors are not watching.
Is it also because there's a lot of small cap financials in the index as well, and their sensitivity to interest rates with that?
I think that's part of it as well.
Right.
But I think, you know, there's even 20% of the Russell 2000 today that if you really broke it down, I'd say that they shouldn't be there. They shouldn't be in business. In fact, 20% of the Russell 2000 today actually needs to borrow money to pay interest on their current debt. And that's a pretty staggering statement in today's world.
So would you say that rising interest rates help risk-conscious small cap managers?
I think it's key part to this normalization process. Rising interest rates are going to help active managers, especially those active managers that tend to focus on risk with the idea that balance sheets matter, fundamentals matter. We've lived in an environment for a period of time now where that really didn't mean anything, and it's actually hard to believe you actually say that, but it's true. So I think rising rates actually help that, active managers. I also think you're at a moment in time where you've got, you know, close to new highs in the market and low volatility. And so you're going to see some risk events, I think, pick up and higher volatility, all of which will be good for small cap. Well,
you had mentioned that almost 20% of the index, they have to borrow money just to operate day to day and pay off the interest that they currently have. What small cap companies should investors be focusing on then?
I think the key in the small cap space today is you have to be selective. Given where the market is, given the lack of volatility we've seen over the past, I'd say, year, really. You haven't seen a lot of volatility except going back to the beginning of this year. You're in a market where you've had, you know, at the moment we're up north of 10% year to date. This will be our third year in a row of double-digit returns for the Russell 2000, something we haven't seen in 20 years. So you should see lower returns in a volatile moment coming up. That being said, the economically sensitive and cyclical areas of the market, we think is a very interesting area of the market to be investing in. Industrial companies, machinery businesses, materials, all represent, we think, great investments at this moment in time.
Well, to wrap up here, there's two camps in the market right now.
Yeah.
You have people that are still excited about the bull market, even though it's a little bit long in the tooth. And then there's the other side where they're starting to get concerned where we are in the economic cycle. Where do you fit in?
Well, I think that's part of the debate in the market right now. There's been an enormous wall of worry around the market. You know, we've just had a second quarter of 4.2% GDP growth. Most likely you will continue to have strong economic growth over the next several quarters. You're probably going to have strong earnings growth over the next several quarters for those companies that actually have earnings. So I'm in the camp that you're at a moment in time where you're going to see increased volatility, just because I think we've all been kind of lulled to sleep with the lack of volatility. And I don't know what that moment is going to be or what's going to cause that moment, but I think it's a moment to take advantage of. You haven't seen a 10% correction in the Russell 2000 in close to 2 years now, over 2 years, I would say. And so any increased volatility is something that we as an active manager hope to take advantage of.
All right, well, thank you very much for joining us at MarketSite. And thank you for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.